Is this your notes?
The one in the bottom, but I don't know whose notes are at top.
All right. So. Hello. Just getting ready to start cranking. Everybody seems late today. Or there's going to be a lot less. We were packed.
No, you can take that chair. I don't want to take that part.
Okay, we'll give you time to get organized. You want to get rid of one of those chairs?
Just bring it
Sure, that one's comfy.
Oh, it's fine.
Okay, we're going to start with chapter 7 on page 181. I don't know if this is good or bad, but you're going to have to read the chapter and know the stuff, but you're not, you won't use it much in tax preparation, and they're not going to have as many questions on this. But I'm going to go through it with you anyway. Okay, ready? Here we go. So, general business credits. That's the 3800 is the form. It's got a lot of credits on it. Those credits aren't used very much. This isn't even covering but about half of them. So they may even have some stuff that's not even in this book. Okay, so all of these credits are non-refundable. That's one thing you kind of need to know. And the corporate limited is simply the net income tax administration. As of 2018, corporations are not subject to alternative minimum tax and therefore do not have tentative alternative minimum tax for this limitation. Okay, that's a lot of that's, you're not going to ever do that much in real life. Okay, the general business credit will not be available when tentative alternative minimum tax exceeds the regular tax. So, does everybody know about alternative minimum tax? We've gone over it, I think, in other parts. But okay, so you get a credit for alternative minimum tax in the years after alternative minimum tax in some situations. But it can never be if your regular tax is $60,000, okay, which hopefully none of us have to see again. Actually, that would be a good thing. If your regular tax is $60,000, that means you made a bunch of money. Okay, so if your regular tax is $60,000 and your alternative minimum tax is $75,000, that means you'd have to add $15,000 to your regular tax, and you'd have alternative minimum tax of $15,000. Okay, but on the other years, after you've already had that, and let's just say you'd had $15,000, well then maybe you get to subtract some of that from your taxes in later years. And what they're telling us here is it can never go back 60. So if you had $50,000 and your alternative minimum tax was $55,000, the most alternative minimum tax deduction you could get is $5,000 and bring this down to $55,000. That's probably the only question you're going to have about the alternative minimum tax credit. I think we had that in part 1. They're not, because they did away with alternative minimum tax for corporations. They may not have any of this. Okay? But just remember, your alternative minimum tax credit can't take you down below alternative minimum tax. So if you had a credit of, if your alternative minimum tax wasn't but $40,000 and your regular tax is $60,000 and you had a credit of $15,000, you get a credit, and that would bring your total taxes down to 45,000. That's still above 40,000, so you'd be okay. Are we gonna see, this is pretty, you don't see this a lot or at least in my tax world, we don't see that a lot. Do you do a lot more corporate taxes?
Yeah, but I never get to touch those yet. I see tax like C Corp paying $20,000 a year.
How much?
$20,000 a year.
$20,000 a year? That's not so much.
I mean, some of them, and then
I wish I only paid $20,000 a year.
I mean, depends. I saw a lot. I mean, it's also doing Popeye.
Popeyes? Do you get free chicken? Okay.
Oh, that's good.
So let's go, we're gonna go over now, under the general business credit. What it really is, they don't have the form, but it's a list of all these credits that you can get. And lots of them, most of them, have their own form, and it carries to the general business credit. You know the CR form on the state? You know what I'm talking about on the state? Okay. The CR form is the credits. There's refundable and non-refundable on the state. But all the other credits carry to that form. And then they go and they get subtracted from your tax. Well, this general credit is the same way. But remember, they're non-refundable. So we're going to go small employer insurance credit. That's one of them. Then there's disabled access credit, work opportunities credit. They don't even give but about half of them in here. Investment tax credit, business energy, rehabilitation, qualified advanced coal project. We don't have a lot of coal in Hawaii, so that's probably not going to work. Okay, so there's this whole. Okay, so we're going to go small employer insurance credit. So if you got Obamacare insurance, you could get a credit against some of that health insurance. That's the business owner. And there's a whole lot of the rules. You can just read them. If you get one question over this, that would be about it. Disabled access credit. You can, if you do not have more than 30 employees or more than 1 million of gross receipts, you get a credit for removing physical barriers to your place. Okay? This is one they've had a question on before. Remember, it starts at $250 and it stops at $10,250. So it's a 50% credit, and the difference is $10,000. Half of 10,000 is 5,000. The answer usually is, how much is the credit? And the answer is 5,000. But they could trick you. Instead of they only had 7,000 worth of expenses. How much is the credit? It would be 3,500. Okay, but always they've had the same one question, and the answer has been 5,000. Work opportunities credit. So there's a bunch of people that if you hire people that are disadvantaged, you could get a credit. I did this back a long time ago. So you got to get them in the first year. On the first $1,000 they earn, you get 40% of that as a credit, $2,400. That's a good deal. If you look down under E, there's a list of all the kinds of people that can get it. Qualified recipient of temporary assistance. That means needy families. You're on welfare, you can get it. You have veterans, ex-felons.
Oh, that you hire employees with this.
Yes,
Right.
and then you get this credit.
Oh.
But there's a little more to that and all that. There's also, you can get it for second year, but it's reduced. And basically just read it. There's also a few other little things in there. So, if your family's on welfare, that's good enough to get it off. So there's a lot of different little things. Who gets it mostly? The military. Veterans got it. People that came out of prison used to get it. People that were on welfare, needy people. And what was it? It was a way to give you incentive to hire somebody that was in need. Yeah. Okay, let's just go to page 184, investment tax credit. That's the 3468. For us, we have solar credits that we get. Okay, and for your individual, your solar credit, I can't even remember the name of it. For the federal, it's 30%, and for the state, it's up to 35%. For the state, it doesn't matter if it's a rental property or personal property. On the federal, if it's a personal property, it goes on one form. I can't remember, 60 something. Starts with a 65 something maybe. Anyway, if it's a business, a rental property, it would go on this 3568 form. But you still get the 30%. What do you have to do if you do that? You'd have to, if you're, let's say that you got 30,000, 30% of 30,000 is 9,000. You got a $9,000 credit. Then you would have to reduce your depreciation of your $30,000 solar that you can depreciate by the $9,000 credit. So if you had $30,000 is what you paid for your solar, you got a $9,000 credit, you would reduce the solar to depreciate by 9,000, or you'd depreciate 21,000. Everybody got that? Okay. Some of this stuff I'm not going to really go in. Rehabilitation, your credit is equal to 20% of the certified historical structure. Qualified advanced coal, I've never ever seen that one before. Qualified gasification project, qualified advanced energy product, research credit. A tax credit can be claimed for expenses related to increasing research activities in a trade or a business. Okay, the following is a calculation of the credit for research. So you can get up to 20%. Just basically read all that. None of this is, okay, this chapter is probably going to have less questions about it than any chapter we got in the book. But you still got to know at least the basics, because you don't know which one of these they're going to pull on you. Pension plan startup cost, okay? If you start a pension plan, your startup cost, the amount equals to 50% of the startup cost, but the limit is only $500. That's not much of an incentive. That's what it is. FICA tip credit, unrefundable tax credit is allowed for an employer. Portion of FICA taxes paid on employee cash tips exceeding the tip status. Okay. Paid family and medical leave credit. If you have paid family leave, you can get a credit for that. Okay. Net operating loss. This is not part of that 3,800. Net operating loss changed this year. How did it change? It can only be carried forward. In the past, you had to carry it back 2 years, then 1 year, then forward. You could opt out of that and only carry it forward. Now, there is no need to opt out. You can only carry it forward. So what does that mean? Another rule is you can only get 80%. So, I have a net operating loss of $10,000. last year I lost a bunch of money in my business and I got a net operating loss of 10,000. So this year would really go kind of on line 21, but I can subtract that $10,000 from my on my tax return. So
From where?
on line 21, other
Oh,
income,
other
it would be a minus. How you do it in your software, it depends. But how do you calculate net operating loss? So now they're all brand new. It's deductible when carried to a year in which there is taxable income. So if the next year you still have a loss, you could have a net operating loss from 2017, net operating loss on 2018, and then finally in 2019 you have a big gain, income. You made a bunch of money. So you would always take the first loss first. So the 17 you'd subtract it, and if you have enough income, then you'd subtract 18. Okay? None of that is the kind of stuff they're going to give you credits on. To calculate the NOLs, you start with taxable income. Okay? I don't know if I should do this. So taxable income. So your income's 100 grand, and you got $24,000 of standard deduction. So your taxable income is 76,000, right? So to figure out your, oh wait. You'd have to have a loss to figure your net operating loss. So we're going to say we have a loss of $50,000. That's a minus 50,000. So this would be 74,000, and it's a minus 74,000. So you start with your taxable income, and if it's not a minus number, then you don't have a net operating loss. So you would add back. In this case, you'd add back your standard deduction, 24,000. So now you're down to 50,000. And the way I did it, that's it. I made it really simple. So, but let's go over the different things real quick. Okay, so just reading this, so you start with your net operating loss, things that you would add back. Standard deduction, if you had loss from the sale of investment property, contributions to self-employment, retirement plans, alimony, these are non-business deductions. You would add those back. The only one in real life we see much of is your standard deduction. Because they're starting with your net operating loss all the way down to taxable income. So you add back your standard deduction. In the old days, we would also add back exemptions, but now they don't have any exemptions. Okay? Non-business income. You would add back that net of your non-business income. In effect, you would subtract that back out, non-business income. Interest, dividends, gains on the sale of investment property, and treasure trove. I have no clue what that would be. Anyway, so then you get to your net operating loss and you carry that forward. They may ask you about what you would subtract out. If you look at 5 and go through capital losses, just read that. That's about, otherwise I'm just reading it to you. The two most important things about net operating loss they may ask this year is it can only go forward. There's other things you would add back, non-business, the qualified business income deduction. And if you had net operating loss from every other years, you wouldn't count those either. Okay, again, this chapter is not, they're liable to have one question about net operating loss. I don't think they're going to make you calculate it. That'd be a little more challenging. Okay, hobbies. Guess what happened to hobbies? This is not fair. Okay, so you have a hobby expense. In the past, you get to take your hobby income, put that on line 21 as other income. Then you go to your Schedule A and you can write off your hobby expenses. They did away with that now. So you're going to have to count all, so let's say that I'm in a hobby kind of business. I make $10,000. But my hobby business is whatever, I make flower lays for people. It's not really a business, it's a hobby. But my flowers cost me $5,000, and other stuff, other expenses cost me $3,000, and I just barely made $2,000. Now you're not going to be able to write off your expenses. And so they want you to count the income, but don't deduct the expenses. Brand new this year. Do I think that's fair? I don't. The IRS doesn't listen to me. Okay.
Where's how? Oh, there.
We're on page 188. Before the new tax line, hobby expenses to the extent of income could be written off on the 2% deducted on itemized deductions on Schedule A, right? Now they can't. That's the crummy thing. They say they're suspended, and in 2026, then you might be able to start writing them off again. I don't have a good answer for that. You need to make your hobby now become a business, is the correct answer. Some people can't do that. Treat your hobby in a business manner, or otherwise all the income is income and all the expenses not. What if you have a hobby and you lose money? Well, you can't write off. Before, you could write off your hobby income up to the expenses up to the income. So if you made $10,000 and your expenses were $12,000, you'd get to write it off $10,000 worth of expenses, where you wouldn't have to pay tax on that $10,000. I think this was a mistake by the people that did it. They've made several mistakes in that tax law. Now Congress is screaming at each other. They can't get together to fix anything. You do know that the government right now is going to shut down on Thursday, right?
No.
Yeah.
Yeah.
No.
They may get what's called
Extension, yeah, there's an extension.
well, they're going to have a resolution, continuing resolution, where they'll just say, we're going to just continue the way we are. We're not going to do a budget right now. And they may do it till the end of the year. They may do it even longer.
Are they shutting down just one day?
No.
Oh.
Do you remember the last time they did that? How they did it right at the end of the year? In January, they messed up the IRS. Well, the IRS, I talked to the IRS, and they're going, if they shut down, we're shut down. Only essential people at the IRS. And that means the people running the computers and sending out the letters. They're still going to send you a letter saying you owe us so much money, but you're not going to be able to call in to anybody and do anything about it. So they just keep sending out letters, and they finally get to the one that says, give us everything you got.
So they're closing down Thursday till we
It-
don't know when.
We don't know that
They may.
if they don't get a continuing resolution or a new budget, they're not even working on the budget. So if that's it, they either gotta get a continuing resolution or they shut down. The whole government,
Oh my. Except the military.
Yeah.
the military doesn't shut down.
Yeah.
Essential.
But
Essential
I think
employee.
I think they have a paper saying that military still get paid though. I know that for sure.
Huh?
Military still get paid though.
Military's fine. It's
Yeah.
not the military. The IRS is the one that we care about.
Yes.
But there's a lot of other things that, what do you call those people at the airport? The screeners?
Oh, yes.
TSA.
Yeah, it's like
TSA, they made them last time. They couldn't get paid, but they had to go to work.
Yeah, oh.
I'm so
Okay.
glad the military get paid though. That's why I don't have to worry about it. It's like, shut down, I don't care.
Why?
Because my husband is in the military.
Oh.
Because like,
Shut down, then he gets, oh wait, he doesn't even get off though.
No, he doesn't get off, but he still get paid because military gets special.
Okay.
They have something before the password.
Okay. You might want to just check the rules for being a hobby. What's a hobby versus a business? Facts and circumstances is the real one, but just read on page 188, 6, A, B. Okay, casualty and theft losses. The same thing happened with casualty and theft losses. Before, you could have casualty and theft. Now, only if it's a federally declared national disaster. So that means if somebody steals your car and you don't have insurance, you can't write it off. It's no longer deductible, casualty or theft. Only if they steal it in a hurricane. Or flood.
How many cars not even gonna work anymore?
I think somebody will steal someone's boat in a flood.
Yeah.
Okay. So, basically just read all this. Okay, how do we determine the amount you take the adjusted basis, not the fair market value. Subtract salvage value if it's worth anything. Subtract insurance reimbursement. That's your deductible loss. Remember the rule about $100 on each deduction and 10% of your income. If it's a business loss, you don't have to subtract the 10%. You should have already gone through all this in beginning tax practice. Federally declared disaster election. So you can actually take it out in the year that it happens, or you can go back to the year before and amend your tax return and take it off then. All right? This, that might be new. I don't remember that from the past. Revocation of the election may be made before expiration of time. So you go ahead and did it in this year, then you realize I would be way better off if I did it in the year before. You could go back and amend this. The IRS will grant administrative relief to people that were affected for federally declared disasters. That means they're going to suspend examination and collection, but not forever. And they may evade interest. Always heavy vehicle use tax, there's always about one question. First rule, it's got to be 55,000 pounds. It can be other kinds of gasoline. Oh, wait, I got to get these two correct. Okay. Heavy vehicle use tax, 55,000. If the people that own the truck in the beginning are supposed to pay it. If you sell it in the middle, then if the people that owned it paid it, you can proportion it. If the people that were supposed to pay it don't pay it, and the new guy that buys the truck, he becomes liable for the whole thing. When is the date? It's done on July 1st of every year. So it's July 1st till June 30th of the next year. I don't know why it's that way, but it is.
The date to what?
What's that?
What's the date to what? What's this date
I don't understand. Date to work?
for? What is this date used for?
Oh, when you pay your use tax based on
Oh.
who owns the truck. If, say, I owned it from July 1st to December 31st, I'd own it for half the year. Then I sold it exactly on December 31st. Somebody else would own it for the other half of the year.
So you would only pay half the year tax.
Then I would pay half the year. But what happens if I don't pay it? And you're the new owner? You could get stuck.
Oh.
If a vehicle is purchased from another registered vehicle owner who uses the vehicle during the tax year, the original owner owes the tax for the whole period. If the tax is not paid, the new owner uses the vehicle, the new owner is liable for the tax. So, what does that mean for you? If the guy stiffs and doesn't pay the tax, you could be the guy that has to pay it. That's been a question in the past. Okay, so this is the tax that you pay on a vehicle that's 55,000 pounds. Think of a big truck. And what kind, okay? So, but if you have a big farm truck or other kind of truck and you use it on the road less than 5,000 miles, or if it's a farm truck less than 7,500 miles, you can, you get a credit. The farmer can claim a credit or a refund of the taxes, including the price of the fuel. Okay? A credit, okay, you get a credit for the, okay, so if you have one of these big trucks and you use gasoline in it, you can get a credit for all the gallons. And I can't remember the farm number, or maybe it's on here, but we used to could write this off. Every time you'd have a farm, you'd say, how many gallons did you drive? And you put the gallons in the software and it calculates this for you. The only way I remember it from year to year is because I look on it and see it last year. Go, oh yeah, I need to ask that. Okay, and remember for this gasoline tax, farmers are subject to a unique tax laws for fuel credits. So the farmer may claim a credit for all the gasoline, everything except diesel. I don't know if they'll ask you that. Employment taxes, farmers could have to pay employment taxes for anybody that works for them, including parents, children 18 years or older, or a spouse. I'm not sure many people actually do that though. They should be. Here's one that they did a few years ago. Have you ever known that there's a special excise tax on tanning salons? We don't need tanning salons in Hawaii, but across America, especially in places that have a lot of winter, they have what's called tanning salon. You go into a little thing, get in a booth, roll over a few times, and you get a tan. They found that that's not good for you, that it might cause cancer. So now there's a 10% excise tax on that. This, I don't know if they're going to have this, but they might. So what is the form the excise tax is on? $7.20. How much of all the stuff that I'm talking about, there's going to be just a few questions, not much. The problem is you just don't know which question. Something, I don't know if it's worth talking about. if you have a health club and you have, just as part of your health club, you have a tanning bed in there, then you don't have to pay this. Okay. Employer shared responsibility. Do you know that employees, if they have enough employees, they have to provide health insurance? Not in Hawaii, we all have to do that, so that doesn't apply to us so much. But on the mainland, they do. So just read that yourself, other than me going through and telling you. That's about it. So what does it say for applicable large employers with subsidies? If they have too many employees, they have to provide health insurance for their employees. There's companies that when they started doing that, they all started cutting back so they'd have just under their number, or they'd put some of them on there and make them less. A full-time work week is 30 hours, so they'd make them work 28 hours. Kind of like in Hawaii, they have to have you work every fourth week under 20 hours. But if you do that to your employees aren't going to think much of you, because they think this guy didn't care about us, he just cares about making money. All right. Now that is the last easy chapter. The stuff in that, there's not going to be a lot of questions on it, but you still need to read the chapter, do the questions in this book, just in case. So now, here we go. We're going to start. We're going to go partnerships, corporations, S corporations, trust, nonprofits. Luckily, they don't have anything about governmental entities. We don't have to do taxes for governments. Okay, so we're going to skip all the questions. Has anybody done any of these questions and want me to answer any of them? We'll take that as a no. And if you guys do have problems with this stuff, well, the answers are in here. But if you need to, I will be glad to help. Anybody's willing to come in here early. All right, so let's go to page 205. What is a partnership? It's if you have LLC and there's only one person, that's a disregarded entity. That's a Schedule C, unless they choose to be a corporation. If there's more than two people, more than one person, two people or more, it is defaulted to, it's a partnership unless you elect to become a corporation. So partnerships are the default for more than one person. Okay, who can be a partnership? An individual, a corporation, a trust, an estate, or another partnership. Okay? Partnerships includes a syndicate, a group, a pool, joint venture that's carrying on a trade or business that's not a corporation. What does that mean? That's everybody more than one person that's not a corporation, pretty much. Another thing that can't be a partnership is they won't let insurance, tax-exempt organizations. I'd have never seen those two questions asked. Okay, go to 206, partnership agreement. You must have a partnership agreement. It can be a written agreement or it can be an oral agreement. You got to agree. How are we going to divide up the money? How are we going to divide up the assets? Who's going to do what? My personal opinion is never let somebody be a partnership unless they have a written partnership agreement. Otherwise, it's a mess. Because what happens if one guy, no, we said this. No, you said that. What's in writing counts. Okay. The agreement must be agreed to by all the partners. That's for sure, and that's liable to be a question. The agreement may be modified after the close of the year, but before the filing due date, not counting extensions. So that's a biggie. They sometimes trick you and say including extensions. Substantial economic effect. It must have a substantial economic effect. Family partnership. A family partnership is consisting of the taxpayer, and it's got to be his or her spouse, ancestral lineal descendants, trust for the primary benefit of any of them. Siblings are not treated as members of a family partnership. I didn't know that myself. If they had asked me, I would have guessed the other way. Okay. If capital is a material income producing factor, you can acquire partnership by putting money or property into it. Or you can have somebody become part of the partnership. You give them a gift. I give my son $25,000 worth of the partnership. Let's just say each share is worth $1, so he got 25%. Okay? But if income isn't a factor, if it's services, then you can't do that. My son lives in California. I give him 25% of the partnership, but the partnership is all in sales. It's not according to how much money you put in, it's how much work you do. Well, then he wouldn't really be a partner because he's not really doing anything. But if it's money, then I can give him as a gift the money. So he's now got, say we originally invested 100 grand, I gave him 25 grand, so he can have 25% of the partnership. The difference is money. If capital is a material income producing factor, he can be a partner. Okay, one other thing that they're going to go over, if in this partnership I give him 25, let's just say 50%. Okay, I give him 50%, so we each have 50%. And we make $30,000, we would each get $15,000. Everybody good with that? Except if I do work worth, let's say in this case, $10,000, I have to get the $10,000 for my work, and then we'd only have $20,000 left, 10 each. So I would have to get $20,000 and he would have to get 10. They have that question on every year, some form or fashion. So my work would be worth, and they move the numbers around, but it can't change that formula.
So you're gonna pay yourself first, and
then the leftover is divided. Now the partnership, they won't have them 50-50 all the time. It might be 70-30 or 40-60 or anything like that. But they can't really subtract the amount of money that you have to give for, the fair market value of my worth was this. You subtract that and then you divide it up according to the percentage. That's common sense, kind of. We went over qualified joint ventures. Remember when you had a married couple, they could be a qualified joint venture? It's like having two Schedule Cs instead of a partnership. Well, that's what they're going over again. So the rule is, it can only be the husband and the wife. They got to file a joint tax return, and they must materially participate. That's the same as it was the last time. But
and one Form 1065.
They wouldn't do a 10, they wouldn't be a partnership. They would
Oh.
each be a sole proprietor, and you could do it, doesn't have to be 50-50. It could be 60-40, 70-30. But they would each have their portion of all the expenses and income. And in real life, the way you do it, you'd do one Schedule C for 100%, and then you divide it up between the two of them somewhere. You do a worksheet. Okay, constructive ownership. We've gone over this before. So, if I have my partnership, I own 50%, and I have another partnership that I own 60%. Well, then in effect, that partnership that owns 60% owns the other 50% of my first partnership. Then I have constructive ownership, and it would be a related party. So partnership, we'll call this P1, P2, P3. I own 40%. My brother owns 30%, and my mother owns 30%. And over here, well, that's already 100% of that one. We'll make this one, some other guy owns 30%. And over here, I own 10%, but my mother owns 50%. Over here, and somebody else owns 40%. Over here, I own 40%, and this 40% is owned by this corporation, and I own 50% here, and somebody else owns 50%. What I'm trying to show is this partnership owns 40%, I own that, so effectively I have 20% plus my 10% is 30%, and if this is one of my relatives, then I have, this is a related party, this corporation and this corporation. If I own this and my relatives own this, these are related parties. What does that mean? If I have a loss in a related party situation, I can't take the loss. If I have a gain, the gain is ordinary income versus capital gain. That was part one. We went over that a bunch in part one. But we hadn't done it since then. And what is it? You add up not only your partnership. Okay, let's make it another one. So partnership 3 owns 40% of this. And I don't own anything here, but my mother owns 30%. So 30% of 40% is, what is that, only 12%? So if this was not a relative, now I own less than 50%, and that would not be a related party. Does everybody see how that works? We had this in part one, whether you actually have it, because partnerships, corporations, S corporation, and individuals can all own partnerships, right? So your partnership can be a corporation, be a partner. I can be a partner. Another corporation or another partnership can be a partner. Now we're going to get into the fun part of this. Filing requirements. A partnership does use the required tax year. So there's going to be a couple different rules. One is a required tax year. We're getting ready to go over that. 2 is a natural business year. Okay, let's see what would be a good business. I have a ski, I rent ski equipment up in a ski resort. You can only snow ski 6 months out of the year. So at the end of ski season would be the natural end of my business year, right? Because that's when I get all my money comes in, and say by April or May, I close the business and we don't even open up again until November, December, whatever, depending on where you are. That's a natural reason. If you were like on the beach in South Carolina, they only stay open for the summer months, and so their season would probably be over after Labor Day, maybe September. And so their natural business season would end then. The third thing is you can choose under section 444, we'll get to that in a minute, a year ending that's not the required year ending, and it's not a natural business ending. The catch is it can't be more than 3 months of deferral. And we're going to go over that. And one of these questions, they have it every year. It's challenging. So first, what's a fiscal year? The partnership use the required business year. Okay? 1, majority interest. If somebody owns more than 50% of the corporation and their business year is December 31st, you have to use it. If their business year is March 31st, you have to use it because they have more than 50%. That's the majority. The next one is principal partners. All the partners that have more than 5%, if they all have the same business year, you have to use that. So when would that happen? You have 5 different partners and they're all individuals. All individuals use December 31st. So that would be easy. But if you had 4 partners and they each had 10%, and the 5th partner was a corporation or another partnership, and it used a different ending date, you'd have to use that one even though the other 4 guys don't want to do that.
Because it's a corporation?
Because, no, you have to use its ending date if it owns more than 50% of the company. Okay? Lease aggregate deferral. So you have all these different partners that have more than 5%, less than 50%, and they have different dates. So you have 3 different partnerships that own this partnership, or 3 different corporations, or 1 corporation, 1 partnership, and 1 individual. They all have different days they file their tax returns, or that they're the ending date of the year. Okay? So then this is the problem down on the bottom of 208. I'm going to just go through this one. So it's all the same, but you guys, they have this one a lot. Okay, so you have 2 different guys. They each own 50%. One guy's year end is December 31st, and the other guy's year end is September 30th. Which is the one that gives the least amount of deferral? And what we mean, the least amount of months of deferral. So if the closing date for me is December 31st and the other guy is September, so if we, let's just say we use, the end date is September 30th and the other guy is December. So from September 30th, September, October, November, December, he would have 3 months of deferral for the guy on December 31st. Okay? I'm doing them backwards for the month. So 3 months of deferral times 50% equals 1.5. The other guy, his deferral is 0 because his date is 9/30, so he has 0 months of deferral. So it would be 1.5. You add those together, that's the total amount of deferral. It would be 1.5 months. Okay? if we use the December 31st date, okay, so the first guy, A, that is his, so he would have 0 months of deferral. On the other hand, if we use December 31st, the guy that his end date for his year is 9/30, so we would go January, February, March, April, May, June, July, August, September. We'd have 9 months of deferral times 50%, which is 4.5 months. And 4.5 is bigger than 1.5, so we would have to use, which one, guys? We'd have to use the September 30th. It would give the least amount of deferral.
Oh, least amount.
And this has been on there forever, that one problem. Now, sure as I say that, I've been telling everybody for years, no basis, because they had a lot of it. They just took the test and he said there wasn't that much on basis. So, did you have basis on yours? You did?
Yeah.
Well, then go figure.
So how did we get 4.5? I'm sorry.
Okay, so if 4.5, if you started on September 30th is your closing date. So if you'll look up here, if the month of deferral from December 31st is 9 months, starting at December 31st, for if you close the business on December 31st, it's 9 months before you get to September 30th. So you'd count off 9 months, multiply it times the business percentage, 50%. And that's the way you get 4.5. In most of the problems that they have, they won't use 50%. One guy would have 30, one guy might have 40, one guy might have 25. Okay? But they won't make it more than 3 people. Usually it seems like it's 3 instead of 2.
More than 3 weeks.
Yeah, but so you'd multiply the percentage times the month from, you choose both. There's only, in this case, you can choose December 31st or September 30th. You'd have to do both. If there were 3 of them, you'd have to do all 3. And one of the questions in the back that I did, it had 3. I don't remember what page it was on. Let's go see here. Here we go. Question number 10. At your convenience, you can just go back, do that as a practice. So we have Warren Corporation, JCL Corporation, and Mike, just an individual. They all have different days. Mike's a calendar year, which is December 31st. And so you'd pick each one of them. You'd have to do 3 little separation calculations. One if the day was May 31st, one if it's August 31st, and one if it was December 31st. And you count the months on each. And whichever gets the lesser amount. All right. So that's it, the least aggregate deferral method. A year other than one required may be adopted for a business purpose. We've already said that, right? What the business purpose would be, your year naturally ends on that day. Another one would be if, let's say that you had a surf meet. You only had that surf meet once a year. Well, after that surf, you don't do anything for a whole, that would be a natural way to end your business, right, at the end of that surf meet. Under section 444, a partnership may elect a tax year that is neither the required year or a natural business year. The election may result in no more than 3 months of deferral. Okay? The partnership must also pay an amount approximating the amount of additional tax that would have resulted had the election not been made. That could be a question. What, you got to pay extra money if you choose that year. and the tax that would have had to be collected. Other rules: you can't be a tiered structure. You did not previously make this unless it's to have a shorter year. Okay. Just reread, that's about it. Okay, so what are the simple things they have? At the end of your partnership, how long do you have to file? So whatever day the year is, it's going to be the last day of the month generally, and you have 2.5 months. Okay, for partnerships, and it's going to apply to S corporations on down the line. What about individuals and C corporations? They get 3.5 months. So if we end on December 31st, we get January, February, March, and half of April, 3.5 months. So they get January, February, and half of March. So March 15th, they're due. So remember, the name is 2.5 because fiscal years. If my year ended on June 30th, I'd get July, August, and September 15th they would be due. Has everybody got? They're going to probably, that's one of the normal, easy questions you need to know. Okay? If you want to file an extension, you get a 6-month extension. This is another easy question. Form 7004, that's your an extension for a partnership. Okay, and if you file a partnership return, what's the form called? 1065. What is the K1 called? 1065 K1. And you have to file the 1065 unless you don't have any income or expenses or credits. So if you had 0 that your partnership did, you wouldn't have to file a tax return. Other than that, you do. It's not on here, but I believe it's might be $195 per month per partner for not filing your tax return. Does everybody see that? That's a big deal. That's one of the few things a partnership would have to pay taxes on. Most of a partnership, we'll get that in the next chapter too, but most of the partnership is a pass-through entity. That means all the money passes through to the individual and it goes on the 1040 through page 2 of the Schedule E. Separately stated items might go someplace else. If you had interest or dividends, they would go, interest would go either line 8 or Schedule B. Dividends would go line 9 or Schedule B. Okay, 179 would go to the 4562, and just you'd have to, the limits for 179 are first done at the partnership level, but they would also be at the individual level. So the partnership could tell you, we want to do a 179 to all this. And you go, no, let's not do that. That's not good for me. And the partnership gets to decide. So if you have a partner that owns 60% and he wants to 179 it, no matter what you want, you don't get to choose. He owns more than 50% of the company. Okay. Domestic partnerships must file a 1065. Partnerships' total receipts for the year were less than 2. Okay. There are certain rules that the partnership doesn't have to file these special forms. They're number 5. You have, if your receipts are less than $250,000, total assets less than $1 million, Schedule K1 is filed on time, and the partnership is not required to file an M3. What are these forms? They're the Schedule A from a partnership, reconciliation of book income with return income, M1. I think that's an M1. Analysis of partnerships capital account is an M2. Disclosure of total assets, item F on page. Just read all that. You're not going to get asked those things on this test, I don't believe. If so, they'll be in the other chapters. Contributions to a partnership. Okay, so now that was the one big area of partnership. This is the next one. What happens when you put money into a partnership? If I put money into a partnership, my basis in my partnership is how much money I put in. So I start off, I put 100 grand into the partnership, my basis is 100 grand. Everybody good with that? Then at the end of each year, we have income and expenses and distributions. We'll get into that later in the other chapters, but your basis is going to change year by year. If your basis ever gets to zero and you take more money out, you're going to have some kind, maybe a capital gain. Okay? So, but let's say that you put just money in, your basis in the partnership is how much money you put in. Next, what happens if you don't put money in and you put property in? Doesn't matter if it's the property could be a machine, it could be a piece of land. You put some kind of property. You put the property in, and your basis in the partnership is the what?
The market value. I know.
No, it's the basis of the property you put in, plus any gain you had to pay tax on. There's going to be some reasons, we're going to go over that a little bit, but let's say that I have a basis of $40,000 in a piece of property that I give to the partnership. In return, the partnership gives me some percentage. Doesn't matter what it is, it's whatever they say it is. So let's just say 30%. And my $40,000 piece of property, my basis is 40, so my basis in that partnership is now 40,000, my 30% basis. But if I had to, for some reason, I had to pay tax on that I put in, it would increase my basis. So, and there's some rules. If I took the property back out in 7 years or less, then I would have to pay tax on it in between the basis and the fair market value. So we'll say that I had a capital gain of $10,000. That $10,000 capital gain that I have to pay tax on increases my basis. Really what you're going to do is just read this all the way down. There's several examples. Okay, and so one of them is a partner who contributed partner, then receives a distribution of a different property within 7 years. That's one set of rules. Or I put property in, and not me, but somebody else, another partner, takes that property out within 7 years. Then there's another set of way to recognize the gain. Either way, you'd probably have you'd have a capital gain. On 211, contribution of services. This is just like before. If I give my services for a portion of that, whatever my services are worth, that's my basis in the partnership, and I have to declare those services as ordinary income on my tax return. Everybody good with that? That's the same way it was in part 1. If I trade my services, I'm a lawyer. I provide $10,000 worth of legal fees in exchange for 10% of the partnership. My basis in the partnership is $10,000, and I have $10,000 of ordinary income. that I have to pay tax on. Everybody's pretty much understand the same as that's always been that way. What happens if we assume liabilities? I give $50,000 of property to the partnership. My basis is $50,000. If I give, and I get 25%, we'll say. I give $50,000, but my property had $40,000 of liability. 1/4 of that $40,000 stays with me, but 3/4 of it goes that I've been reduced my liability by, right? So 25% of 40,000 is 10,000. This is going to be a problem. So 30,000, I got a relief. In effect, they gave me, like they gave me cash of 30 grand. 10 of that 40,000 is mine, so I still owe that. They owe the other 30. So you subtract the 30,000, and now my basis would be 20,000. That's one of the questions. Okay? How much capital, would I have any capital gain in that case? The answer is 0. If they ask, how much is your capital gain? It's 0. On the other hand, my basis is 50,000. The land could be worth 200 grand, who knows? But I owe 80,000. What its fair market value doesn't matter. $80,000 loan, I get relieved of that 80,000, but I get 25%, so I still owe 1/4 of that. So 20%. The other partners have now taken over my $60,000 of the loan. So my basis is 50. I got $60,000 relief. My basis is 0. How much is the capital gain? $10,000. I have to pay tax on this $10,000. Everybody good with that? Oh God, I can't bend over anymore. Okay. Just by luck, not by luck, they do it this way on purpose. They've got some examples in here. All you got to do is read them. If the contributed property was if that was depreciated property in our basis, that 50,000 had, let's say, it was $90,000 for the value, and they had already had 40,000 of depreciation. When you kept that capital gain, that would be ordinary income, I believe, because you'd be recapturing that depreciation. You've already gone through that a bunch, I think. Okay, partnership interest. The original basis of a partnership interest acquired in exchange for contributions of property is the sum of the money contributed, the adjusted basis of property, the amount of gain, recognized gain. Okay? The assumption of liability by the property is treated as a contribution of money to the partnership and increases the basis. That means if I, instead of having a, let's just say, in this one I had a liability on the company, excuse me. I put $50,000 of property in. And instead of me having any, I don't owe any money. But let's say the partnership owes $40,000. And by me becoming I'm a 25% partner. Now the partnership owes $40,000. I actually will be assuming $10,000 of their debt, right?
Owes meaning owes.
That means the partnership owes somebody. The partnership has a debt. Maybe they have, on other property, they have a mortgage. But by me becoming a partner, I'm assuming that debt. If I assume $10,000 of their debt now, they owed that $40,000 before. But now, since I became a partner and got 25%, now I owe it. Since I owe that, I increase my basis by $10,000. Because really, I gave them a $50,000 basis in the property that I gave them, and I gave them 10 grand. I took on 10 grand of their debt. Make sense? What does that mean? So now my basis is $60,000. If we turned around and sold the company and I got $80,000, I have a basis of 60, only 20,000 of it would be capital gains. If my basis had been less, then I have to pay more tax. Everybody good with that? That will be next week's problem. Because the second chapter is going to be selling. What happens when you dissolve a corporation? Sell it. So on the bottom of 212, they've got a formula: cash contributed, adjusted basis of property, any gain recognized, share of partnership liabilities, increases your basis, and then you subtract any partnership, any of your partner's liabilities that the partnership assumes. This is the same stuff we've been talking about. And if you get any problems, what you might do is just take this little thing and just do it with the problems. It might make it easier. Partnership basis. The partnership basis in contributed property is equal to the contributing partner's adjusted basis immediately before the contribution, increased by any gain recognized by the partner. It is not adjusted for liabilities. Holding periods. So if I had a piece of property that I had owned it for 10 years and I give it to the partnership, now the holding period includes the time that I owned it. It doesn't really matter much if it's over 1 year, but it does. The basis of the partnership interest purchased by a partner is its cost, which is the sum of the purchase price and the partner's share of partnership liabilities. Wow, we're done. Short chapters. But they're harder chapters for you guys to actually read and study. This took me longer to actually do the problems than normally it takes me. I even had to look back through the book a couple times. Questions, anybody? Anything you want me to go over? The next, these next ones are gonna be, the second chapter is short. The next chapter is not short. It's the meat of being a partnership. My personal opinion, partnerships are the worst entity to do taxes for. I don't like doing partnerships, but that's just me. And it scares me because partnerships can start off one way, you're right in the middle, and you get a bunch of partners, let's say more than two, and they don't always agree on everything. And if you're doing the tax return, you could have this is not part of this class today, but we could have a real problem because if you're doing the tax return and then you also do the individual tax returns for some and not all, you could have a conflict of interest. And then you would have to back away from one or the other. Because what happens if they choose at the partnership level, like I was saying, 179, the one partner that's your customer, you tell him it would be good for you to 179 and knock off, you just had a bunch of income this year. You sold something not related to that partnership, and you told him to do that. But it negatively affects the other partners, then you have a conflict of interest. And they call their lawyers and sue you and take all your money. Just kidding. All right, everybody good?